Hello, welcome to the Uncleared Margin Rules Industry Checkpoint with myself, Sean Murray. I am the CEO of Margin Reform. Margin Reform is a boutique management and IT consultancy. I'm joined today by Chetan Joshi, who is the founder of Margin Reform and the COO, and by John Southgate, who is one of our senior consultants. We're going to be talking you through UMR, Uncleared Margin Rules, and what's going on in the market with Uncleared Margin Rules, how clients are getting ready with Uncleared Margin Rules. We're going to look at some of the key questions and takeaways from our industry survey, and we are going to give you some conclusions and then share with you the link for the survey if you so wish to complete it. Chetan, maybe you could give me a quick update on Uncleared Margin Rules and what's going on.
Sure. So when we look at Uncleared Margin Rules, there are a number of areas that impact organisations. We've worked out in the industry, there's a phase 5 go live September this year, and next year a phase 6. This year, around 300 newly scoped counterparties come into play for UMR, and then the subsequent year there's another 800, and this is an industry analysis. With those impacted counterparties, there's a lot of impact on the ecosystem, and what we're seeing from our client conversations is that the repapering and the custodial onboarding is really important to start from a project point of view. The regulators, as part of COVID, have given regulatory relief where you're allowed to act diligently. And that's been a real plus point for the industry, where you can monitor your thresholds from a 50 million point of view. So as soon as you get to a certain soft limit, you start to do the documentation and the custodial onboarding. So UMR really impacts organizations. And here we've shown you the kind of key points to consider.
Thank you, Chetan. John, maybe we can move over to you and you could give the listeners a bit of an update on the Uncleared Margin Rules and what they're on the hook for and how some of the complexities play out.
Thanks, Sean. Yeah, certainly one of the first steps that when we're working with clients to look at is to understand which jurisdictions apply based on the fund and the counterparty domicile. The distillation of specific rules, there's a subtle difference between each jurisdiction, and trying to understand how this impacts across the organisation from front to back is really important. And we find that it's really important at an early stage for each stakeholder group to be aware of those different rules, who is accountable, and the different solutions that are required. And this really is quite a significant effort, really. Much of the implementation work's dependent on how those rules need to be applied across that organisation.
Yeah, I think there's no getting away from the fact it's a very complex regulation and it needs some serious governance and control. It's planning and detailed planning at best to get yourselves compliant.
Agreed. I mean, there's, as we all know, there are thousands of pages of rules. So it is a very complex area to try and distill down.
Yeah, for sure. Okay, so what is the UMR research about? Well, it's around our ongoing efforts to support clients in the collateral and margin space. This is what we do. It's where our expertise is. And we've done this in collaboration with Institutional Investor, where we've been helping support on educational events and working with clients who are at different stages of their UMR compliance journey or their discovery. We've been developing over the last 5, 6, 7 years different insights to UMR through phases 1, 2, 3, and 4, and now phase 5, which is in the middle of its implementation. There is an opportunity, we believe, at Margin Reform for in-scope firms to assess how they deliver, how they future-proof themselves. And it's not a one-size-fits-all for everybody, but it's a tailored approach. So we've completed the survey. The survey is there for anybody to interact with and then to receive a peer review to support and challenge their UMR process and their progress. And we've covered 4 main areas: project planning, implementation considerations, margin and collateral modelling, and post-implementation impact.
Yeah, so first up, from a project planning perspective, we asked respondents to rank the different challenges from easy to hard. So you'll see they were ranked from 1 easy to 5 hard. So I guess first off, Chetan, anything that stands out there that you'd like to call out?
Sure, John. What really stands out for me from the survey respondents is the legal repapering, which is a real big challenge, and there's so much complexity. And why is there so much complexity? One is that the documents for IM have completely changed from the variation margin agreements, with more data points and clauses to agree with clients, which drive different calculations. Also, the complexity of custodians and the different documents that each custodian has. So there's no standardized documents that each of the custodians use. So you need to understand each of those offerings from the custodians. The other area that really stands out to me is around the technical infrastructure and working out your IM. There are multiple vendors out there around IM. It's understanding those numbers and connecting it to your ecosystem. And that's a real challenge in different organizations who've never computed initial margin before. And last but not least, it's around the risk management and model governance. A lot of the focus is on the technology and the legal documentation, but don't forget that the model has to be controlled and governed properly within your organization, and the regulators are really keen to understand how you govern your model.
Thanks very much.
We've talked about the operational side there, implementation, and what could you do in-house versus what could be outsourced, and is it an existing outsourcing arrangement or a new outsourcing arrangement, or maybe you're not doing any sort of enhancement? But we've got 5 processes listed across the bottom. Maybe John, you could just walk us through what your view on this is and the results back.
Certainly. So I mean, if you look at that, over 50% of respondents are enhancing in-house in every category. What really stands out there for me is the high percentage around legal agreement negotiations doing that in-house. Yeah. Certainly through our experience, that's a real, really challenging area for clients, and getting external expertise will really help, introduce efficiencies into that process. So that does surprise me. What doesn't surprise me is the looking to IM threshold management, margin calculation, and collateral optimization. They're being reasonably high. Percentages of respondents looking to outsource that, and that's they're new outsourcing relationships. And again, I think that marries really well with what we're seeing when we're working with clients. Is they realise that they haven't got the in-house expertise. These vendors that are out there to provide these types of services, there's a multitude of them that have emerged, and it really does make sense to use their expertise and implement that into your own existing processes potentially. So I think any vendor that's in the playing the space will attest to, there's real opportunity here for those types of outsourcing firms and for vendors to step in there and take up some of the slack.
Yeah, very good. And Chetan, anything from your side that's jumping out here?
Yeah, sure. I think what's clear with the regulation is there is no competitive advantage around the standard regulatory rules. So there is a shift now from in-house builds and in-house operating models to moving to outsourcing or managed services, because the solutions you can buy off the shelf. When we were implementing this for phase 1 firms, those offerings weren't around, and everything had to be built in-house. But now there is a shift from in-house to outsourcing and finding the right vendors and delivery partners.
So starting to see more consistency in the market, I think, is what you're saying.
Yes, exactly.
Yeah. I guess one point I noticed on this, which made me chuckle, was the 10% of respondents who don't think there's going to be anything to do on legal agreement negotiations, when clearly initial margin is all brand new for every phase 5, phase 6. So there is definitely going to be some requirements for everybody in that sense.
So this question is a question that gets asked in pretty much every engagement that we're in, and it's been heavily discussed in the industry. And it's around, will you be using tri-party or third-party custodian models for initial margin exchange? And John, as our industry expert at margin reform around the custodian models, could you give us a view on what you're seeing here with the results, please?
Certainly. So, as we all know, phases 1 to 4, the dealers really favoured the tri-party route. However, I think what we're seeing for phases 5 and 6 is, those types of buy-side firms that are coming in phases 5 and 6, they're looking to retain assets with their custodian as much as possible. So I think we're seeing a mix of the two potentially, whereby those types of firms would be looking to deliver assets through their third-party account structures that they have at their custodians, but obviously the dealers are still looking to deliver to those buy-side counterparties through tri-party. And what's the fundamental differences between tri-party and third-party? Well, Tri-party, as many people will know, that's a really acts. If you think about it, it's a centralized collateral management function. So there are huge operational benefits through that in terms of the automation that it provides to the parties taking part in it. That comes potentially at a much higher cost compared to third party, whereas third party, the accounts are opened at the incumbent custodian and assets are moved in as directed by the underlying buy-side counterparty or indeed their collateral manager. So it is a lot more, it's a higher touch that's required from an operating model perspective, but it does ensure that, if clients have got their own collateral optimization functionality, for instance, they can use that rather than relying on the tri-party agent. So it really is, there's no one size fits all. We're certainly seeing, in terms of the phase 5s that we're working with, a real mix. I actually would expect to have seen more of those buy sides looking to go down the third party route, but actually I think just to have maybe firms are thinking to have a consistent operating model across delivery and receipt. We're still definitely seeing a prevalence of tri-party, but I think that's starting to shift away. And as we get into phase 6, maybe clients that have an established collateral management infrastructure might be looking to leverage that and go down the third party route more frequently.
John, you come from the custody side of things. So do you, on the legal documentation for tri-party, third party, do you think there is an understanding of the two differences generally across the market for the buy side?
That's a good question, Sean. I think there's been a lot of work done at the custodians to try and standardise their account control agreements. And as we all know, each custodian's gone through the ISDA blessing process to have them approved and fit for purpose to meet the regs, and that they're kind of standardised, but they are not standardised across custodians, so they're still very different. So, to your point, I think the tri-party documentation there's less room for negotiation. The tri-party agents typically don't want their documents to be negotiated, so that and obviously they're much more widely understood in the market. But that said, the work that's been done with ISDA and the custodians has helped a lot, and also away from the legal agreements, kind of standardising the messaging around those third-party accounts. There's been a lot of work done by the custodians, but if you looked at it side by side, is there more scope for negotiation and differences between custodians from third party to tri-party? Yes, there still is, I think.
Yeah, I think that the summarised version of that is there's standardisation within the custodian, but not across the custodians.
Yeah, that's absolutely it.
Okay. So
this question is really looking at the respondents' thoughts around how they're going to implement their initial margin calculation. So be it using ISDA SIM or the schedule grid methodology. And I guess there's a mixture of those across. So CJ, having a look at these responses, what are your thoughts around how that marries with what we're seeing, particularly, I guess, with clients that we've been working with?
Sure. This is probably the most important decision to be made as part of the project around implementation. And when we look at the SIM, the standard initial margin model, this has been developed by the phase 1 banks, and then phases 2, 3, and 4 have come in. So the model is changing every year. We know it's not a perfect model, so not all risks are in the SIM. And the key thing for organizations to do is get their portfolio, their specific portfolio, and put it through the ISDA SIM, and also put it through a regulatory schedule model calculation. So the regulators have a very simple setup on the table as part of the regulatory rules around working out the grid. And that really helps you understand your portfolios and if there are any kind of risk offsets. So when we look at ISDA SIM, it's based on sensitivities, risk sensitivities, and working out what portfolios work with the best model is a key first step. The dealer community are very supportive and very collaborative, helping the buy side by providing their view of the numbers. So that helps you validate your calculations. And it's interesting to see here the mixture of responses in this space. And there is no right or wrong option here. You can use a mix, and we've seen some clients for certain asset classes using the regulatory schedule, and for the rest of the asset classes using the ISDA SIM. So it's working through the portfolios and working out your IM projection. And also what this helps you do is works out from a repapering point of view, which clients do you have to document first, and which clients would you then move onto a threshold monitoring process, which allows you to act diligently.
Couple of points I'll add to that, John. primarily that historically, go back to the first few phases, this is an industry model, and SIM is meant to be cheaper from an initial margin perspective. So grid was meant to be 8 to 10 times more expensive. In the workings I've personally have gone through, that hasn't always been the case, and certainly with clients it hasn't always been the case either. So it's definitely worth doing that iterative process to understand what your IM numbers could look like. And then I think the second thing to note is that there are a multitude of different vendors out there offering SIM and grid calculations now. I think at last count, these are all through ISDA. They'd have to be, I think there's over 25 different vendors offering the model calculation service to clients, which wasn't in existence back in 2014-15 when UMR was kicking off in earnest at the dealers.
Thanks, Sean and Chetan. That actually brings me on. So a follow-on question to this is, while there's a lot of focus in the industry around the model itself and the numbers and how that compares to your counterparties, I think an area that often gets overlooked is the regulatory requirement around back testing and benchmarking. And certainly looking at this slide here, that I think that definitely marries with what we're seeing when we're working with clients around the high percentage that are undecided. So CJ, would you like to talk around some of the processes here and why we think maybe there's more uncertainty around this than there is actually the numbers that are coming out of the model themselves?
Sure. No, it's a great question that we get asked a number of times. And the reason why there's a high volume of undecided respondents is it depends on your regime and where you are. So some regulators don't have assertive text around back testing, benchmarking, some do. There's also industry pushing lobbying and advocacy around diluting the benchmarking and backtesting model validation requirements for phases 5 and 6, and we're still waiting to see those changes coming through, in particular in Europe as part of the UMR refit. But the phase 5s won't be able to bank on those changes, so there will be a reduced scope around what they do around model validation. But backtesting is a best practice, regardless of it being UMR. When you have a model and you're computing a number, you need to make sure on a consistent basis that calculation, that forecast makes sense. And part of the backtesting for UMR is done every 3 months. So you go live in September, end of the year, you'd run your backtesting, your quarterly backtesting to see if your numbers are working out the way you expect it to work out. So there are different ways you do backtesting as well, and people get confused on that. We help clients understand the pros and cons. There's no right or wrong solution from a backtesting point of view, but it's really important to do that. And the benchmarking, there are different solutions out there around internal benchmarking to a model like a VAR model, or looking at a CCP model. And there are vendors out there that can help you manage all of this. And it also involves a lot of data, and it's quite expensive. So it's really important to understand the strategies you're going to have around backtesting, benchmarking, and then the validation of the model.
One of the things I'd add to that, John, is around potentially the external validation, which we haven't addressed in this question, but it's potentially critical as we go through phase 5 to phase 6s. So let me give a war story from my time at the phase 1, where I led a delegation of 10 or so people from Singapore to New York as a US swap dealer, my previous employer. We had to go through around a week-long exam with the Fed in New York, where we went through how we built the model, how we tested the model, how we back-tested, benchmarked the model, how we'd gone through an internal validation on that model. Now, we do expect I guess a lessening of that. I wouldn't expect buy sides, phase 5s, phase 6s, phase 4s even to be doing that with their local regulators. But I would expect there's going to be some level of attestation that every entity has to do at some point externally, whether that's a letter written to their local regulator or whether it is some form of analysis that needs to be provided. But externally as well, I think it's critical not to forget that you've got a regulator who is interested in what you're doing and they want you to stand behind that model. They're also interested in the risks that are not in SIM. So as an example, SIM is a parametric VAR model. It's meant to be fairly simple so that the industry can follow it, update it, agree with it, and everyone can move in unison on it. So you may have some products, structured, exotic, whatever, that are not necessarily in the SIM, and you need to understand that as well and work with your internal SIM model owners to understand how that process works.
That's great, thank you.
So when we look at post-implementation considerations, do we expect a shift towards utility type infrastructures to support industry-wide management of margin, collateral, risk and risk processes? And I'll start with Sean on your view on the respondents' results here.
I am in agreement. I believe there is going to be a shift. I think, in fact, there already is a shift towards utility type infrastructures, as we've seen with variation margin, portfolio reconciliation, and initial margin. And we know the vendors out there that the clients are using, first 4 phases for VM and for IM, and there are different vendors doing different things. So I do certainly expect it to continue. I expect it to grow. I believe that with clients, particularly when they start to understand the costs of getting compliant and then the ongoing compliance of UMR, that there is going to be a requirement to change. Now, that change could be through personal investment, through their own means. Obviously, enhancing technology is one thing, bringing in different resources with different expertise is another way of doing it. But with a lot of this processing, there is a way to industrialize it with others and reduce your costs and make yourselves more efficient.
Yeah, I agree. And John, what other areas do you see driving this? We're focusing on UMR and initial margin, but what other areas should people be thinking about with the utility?
Yeah, I mean, we're definitely seeing a lot of focus on clients becoming compliant for UMR and initial margin, and I think it's important, right? Because that deadlines aren't moving now, so they need to be compliant. But what we're starting to see, and I think we'll see more of as we get past phase 5 and phase 6, is while some firms have been happy to implement a split model across VM and IM, as I say, to get compliant, I think that's there's a move towards a more holistic approach, and you can't realize efficiencies if you've got a split model. We all know about how if clients are trying to implement collateral optimization, you need to look across that holistically as well. And so I think there's an opportunity there for those utilities and vendors to work, to look back at what's been done already for VM and implement what they're doing for initial margin and draw that across to VM. But also, I think what we're seeing from the custodian space is there's an expansion of the services that they're offering. So, as you know, a lot of the custodians have provided a kind of a middle office outsourcing platform in the past, and this is really giving them the opportunity to expand upon those services that they're offering to clients. And I think that helps the buy side in particular try and be as efficient as possible, where they can leverage their custodian relationships to perform some of these activities for them.
Great. No, thank you both.
So this again is around the post-implementation world and going down that utility, following that utility angle. So which parts of the margin process do you consider an outsourced utility could cover? And Chetan, maybe, in fact, John, let's start with you first.
Sure, thanks, Sean. I mean, it doesn't surprise me here. Look, we've got margin processing and reconciliation and dispute management. Over 50% have said that they would consider that, and that makes sense. They're very traditional areas in which we've seen the buy side outsourcing in the past. They feel comfortable outsourcing that. So it really makes sense. Again, we've spoken in the last slide about efficiencies and clearly an industrial process to perform those activities makes a lot of sense. Interesting for me is the optimization piece. Nearly 40% are saying that they'd outsource that, and again, I think that ties in with what we're seeing. That there are numerous vendors out there that can perform that. Not always the same vendors that are performing the kind of the reconciliation or the margin processing piece, but and that in itself causes complexity, right? Because then there's integration that needs to happen between your optimization systems potentially.
Yeah.
But that's, I think, the challenge there is an off-the-shelf optimization tool. How does that meet the specific needs of an underlying buy-side firm? Whereas things like margin processing and reconciliation, that's pretty standardized. So, but it is interesting to see that. And data management, I think, an area is a piece. I guess CJ, that's an area that we're doing a lot of work with clients. We're seeing a lot more buy-side firms looking to think about that. I mean, what were your thoughts around that?
Yeah, definitely. I think the data management can be a boring area for organizations, but when you look at the legal documents, there's so much data that needs to be captured, And historically, that there is no golden source of legal data within organizations. So where do you put that data? If you have the wrong place, poor data coming in means poor data going out, and the legal data really underpins the whole ecosystem from an IM and a VM perspective. You also have future regulations around IBOR which are impacting data. So what we're seeing is now a trend in the buy side where they're looking at legal systems that can harvest the data for you, but it also can feed regulatory provisions, working out calculations of worst of, depending on the regulatory regime, but also the data you need for back testing, which is a lot of information. So it's really important to have in your thoughts around how you're going to control this data, because you don't want to touch the data consistently. You want to be able to put it in one place and then allow it to automatically cascade to different providers. Otherwise, you have operational risk where you're keying in data into multiple systems, and that's not a place you want to be when you get to the complexities of UMR.
One other thing I think about this slide as well is we know there are how vendors playing in each of these different areas. There are some that offer cover almost all of these areas, but very few. So it's a challenge for clients to try and understand when they're looking at their operating model, whether they go for a provider that kind of ticks all the boxes but maybe are weaker in certain areas, or whether to go and choose specialists and integrate them. And there's a lot of work being done in the vendor space now to try and integrate where, say, I'm just going to pick an example, you've got a collateral optimization specialist or maybe a pre-trade optimization specialist, how they can then interact with your margin processing service provider as well. So, a lot of work's been done. I think there's a lot more work to be done in that space. And for clients, it's, if you really truly want best of breed in each of those, it may well mean that you need, more than one provider to fulfill that space.
Yeah, it's very much a journey, isn't it? I think you've both sort of gone into that in quite a lot of detail. It's a journey. Starting points are different, end points are different. What do you want to put in the middle? What's going in your sandwich is critical to understand. And as you say, there's a lot out there, and understanding it is complex. And that's why we're here to help. So thank you both. That's a really conclusive answer on that question. That does bring us to the end of the survey review for Q1. We have the survey open until phase 6 go live of UMR, which is 1st of September 2022. So if you would like to complete the survey and benchmark yourself against your peers, you're able to, and there is a link on the PDF deck that is sent out. It's a multiple choice survey, will take around 15 to 20 minutes maximum, and you're able to obviously share the results internally with your project teams, your program teams. So from me, Sean Murray, Chetan Joshi, John Southgate, thank you very much in advance for your time. We appreciate your insights and contribution to our research with our partners at Institutional Investor. Thank you.